Come up with the most hikes.
You're absolutely right, Oliver. Everyone has an opinion about how many hikes there will be, but the bottom line is nobody knows. So, but you're absolutely right. Sort of the general tone has moved to higher numbers, and I think that's what's sort of kept the lid on the markets here. The main focus, of course, is still inflation. Everybody's watching that closely. This week, we don't get a lot of inflation numbers. The only thing I think that might be important, it's kind of flying under the radar right now, is the OPEC Plus monthly meeting this week. Maybe we'll hear a little bit more about what they're going to do, because obviously the higher the oil prices, of course, that sort of adds to that inflationary overtone. So again, we'll see something there. I think outside of that, the biggest thing is going to be obviously the jobs number on Friday. But we already know the job situation's in good shape. Everyone knows that. We know that. The big question is inflation. That's the question mark that people want to know, and we don't get a lot of information outside of oil on that this week, Oliver.
Wages is going to be big on Friday. Okay, gentlemen, thank you for your contributions. Scott Connor and Kevin Hanks. That's our meetup panel. I will see you this afternoon for Market on Close at 2 p.m. Trading 360 with Nicole Petalides is up next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo Webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its investor's finest. Tune in live or watch on demand. Right for you. The Platform Demo Webcast. Head over to tdameritrade.com/webcasts and start learning today. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo Webcast series is designed to help you broaden your knowledge of tools and resources head over to tdameritrade.com/webcast. Available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. The Platform Demo Webcast series. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored.
Best of all, you can ask questions by chatting directly with an education coach.
To fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
Options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed the first-of-its-kind personalized education center. Their award-winning content is and it learns with you. So as you become smarter, so do its recommendations.
So it's like
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
I'm searching for info on
90 minutes after the dust settles from the opening bell, Trading 360 brings you
options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
But except now you're binge learning.
See how you could become
360 with Nicole Petalidis, weekdays at 11 a.m. Eastern on the TD
a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
Options trading.
Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
But except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
LeBeau on Bow.
Good Monday morning. Welcome to Tech Check. I'm Carl Quintanilla. With John Fort and Deirdre Bosa today. Stocks rally to close out the month of January. The Nasdaq higher by nearly 2%, trying to avoid the worst January. Ever coming as we await quarterly results from Alphabet, Amazon, Meta, Snap, AMD, and others this week. Then more artists join. John Fort and Deirdre Bosa today. Stocks rally to close out the month of January. The Nasdaq higher by nearly 2%, trying to avoid the worst January. Young and calling for a boycott of Spotify. Despite the exodus, the stock does get an upgrade today, along with some other subscription-based companies. From Alphabet, Amazon, Meta, Snap, AMD, and others this week. Then more artists join. Plus, one Wall Street firm deciding to buy now. The analyst calling the bottom on a firm. Is with us this hour. We're going to start though with the market. Tech is surging at the end of what has been a upgrade today, along with some other subscription-based companies. Tough month, and we are set to get a whole roster of catalysts this week out of earnings and some macro. Mike Santoli. Plus, one Wall Street firm deciding to buy now. The analyst calling the bottom on a firm.
Yeah, Carl, market giving back just a little bit of what's been taken.
Is with us this hour. We're going to start though with the market. Tech is surging at the end of what has been a
taken from some of the hardest hit areas. That does kind of NASDAQ 100.
Tough month, and we are set to get a whole roster of
100 type
catalysts
stocks
this week
qualify,
out of
but also,
earnings
you know,
and some macro. Mike Santoli.
the hyper-growth pandemic stories. And a 2-year chart is kind of fun right now. Just a little bit of what's been taken. All right, it takes you right to the precipice of the COVID crash. And here's some kind of NASDAQ 100. Those names: Snap, DocuSign, PayPal, up almost exactly, a similar amount over that span of pandemic stories. A 2-year chart is kind of fun right now. And still outperforming the S&P 500 even after making this. Those names: Snap, DocuSign, PayPal. Huge round trip higher. What's interesting is, you look at Snap, PayPal, up almost exactly, a similar amount over that span of. Or DocuSign, they trade right now at effectively the same price to sales. The S&P 500 even after making this sales ratios as they did 2 years ago. So no more expensive. Huge round trip higher. What's interesting, but also you wouldn't necessarily say cheap. It's just that they overshot on the upside. So the earnings that they're going to deliver probably going to give maybe some hints about what they trade right now at effectively the same price to sales. Longer term path is fundamentally for these stocks, even if right now what we're you wouldn't necessarily say cheap. It's just that they overshot. Seeing mostly, I think, is these reflex bounces from some of the most. So the earnings that they're going to deliver probably going to give maybe some hints about what the washed out areas of the market.
This Boeing 10K we were just talking about.
Longer term path is fundamentally for these stocks, even if right now what we're.
About in terms of raising more money, does bring to mind IG spreads and
mostly, I think, is these reflex bounces from some of the most
and high yield spreads close to a 1-year high. I wonder how much that's on your radar at this
washed out areas of the market.
This Boeing 10K we were just talking about. This point,
for sure, financial conditions are tightening, but from very loose levels, so they're not really. Kind of going across any tripwires that say, okay, now all of a sudden conditions are tight or the market's being stable.
And high yield spreads close to a 1-year high. I wonder how much that's on your radar at this.
About credit, but it's trending in that direction, and it's becoming a little bit at the market.
Point.
For sure, financial conditions are tightening, but from very loose levels, so they're not margin less supportive of broad equity valuations. You do wonder, though, how kind of going across any tripwires that say, okay, how much, the S&P falling 10, 11%, and the average stock going down 15% over that time is most, and it's becoming a little bit at the market. They've been telling you that story already.
Mike, some bright spots last week, of course, were Microsoft and Apple earnings. Do you think that could represent sort of a turn? For perhaps the bottom, especially as we have Amazon, Alphabet.
Over that time is most
Meta all reporting this week.
It can't hurt. I story already.
Mike, some bright spots. spots last.
I actually do believe it really after the declines we've seen in most of those stocks. You've had
Microsoft and Apple earnings. Do you think that that could represent sort of a turn?
The moderation in the valuations. But the problem is the market hasn't been directly
Amazon, Alphabet.
rewarding earnings beats in general very much. It can't hurt. The ones that miss it are getting obliterated down to most of those stocks. You've had 2.5% relative to the market on the day that they miss. The ones. The problem is the market hasn't been directly. That are beating are just getting a slight advantage. Earnings beats in general very much. Over the market, so I wouldn't say it's enough to really propel the entire. The ones that miss it are getting obliterated down to. Market higher, but it's something that you can actually look and on the day that they miss. The ones touch and feel and say this actually can help me value these stocks as a. Over the market, so I wouldn't say it's enough. Opposed to just worrying about the macro swings, at least right now till we get to the jobs report. Market higher, but it's
all right.
Something that you can actually look and
Mike Santoli, thank you. Now, one company reporting earnings this week. Spotify, several high-profile artists raising pressure on the
swings, at least right now till we get to the jobs report.
Company to take a stronger stand against misinformation on the platform. Specifically, they take issue with the Joe Rogan Experience podcast. Julia Borston has that for us. Hey, Julia. Several high-profile artists raising pressure on the.
Well, John, Spotify is taking steps to address concerns that its popular
against misinformation on the platform.
Joe Rogan podcast is spreading dangerous COVID misinformation.
Experience podcast. Julia.
Neil Young, Joni Mitchell, and Neil
Borston has that for us. Hey, Julia.
Lofgren, that's Bruce Springsteen's guitarist. They pulled their content from the Joe Rogan platform, and popular podcaster Brene Brown says she won't release new episodes of her podcast on Spotify. This is growing. Lofgren, that's Bruce Springsteen's guitarist. Backlash after, in late December, a coalition of scientists platform and popular podcaster sent Spotify a letter raising concerns about misleading claims. Release new episodes of her podcast on Spotify that Rogan and his guests have made. Spotify CEO Daniel Ek responding over the weekend, saying they don't want to be a content censor, but sent Spotify a letter raising concerns about misleading claims. Quote, "We know we have a critical role to play in supporting creator expression that Rogan and his guests have made." Spotify CEO Daniel Ek, while balancing it with the safety of our users. And now responding over the weekend saying they don't want to be a content censor, but announcing that Spotify is adding content advisories to podcasts that discuss COVID-19, directing listeners role to play in supporting creator expression to a COVID-19 hub, publishing their platform rules and helping creators understand their accountability of our users. And now ability. Rogan posting a video that Spotify is adding content on Instagram saying he supports Spotify adding content advisories that discuss COVID-19, directing listeners to a COVID-19 hub, publishing their platform.
They're just conversations, and I think
Rules and helping creators understand their accountability.
that's also the
Rogan posting a video.
appeal of the show. It's
On Instagram saying he supports Spotify adding content advisories.
one of the things that makes it interesting. They're just conversations, and I want to thank Spotify for being so supportive during this time, and I'm very that's also the sorry that this is happening to them and that they're taking so much heat from it. Appeal of the show. It's
The efforts to address the controversy seem to be
interesting.
benefiting the stock, and a city upgrade to buy is also sending those
for being so supportive during this time, and I'm very
shares surging now up nearly 12%. Cities saying they believe
them and that they're taking so much heat from it.
Spotify can improve its ad support. The efforts to address the controversy seem to be supported monetization. That analyst will benefiting the stock, and a city upgrade to buy will be joining us in just a minute. And speaking of advertising, there hasn't been any shares surging now up nearly 12%. A word of advertiser boycotts, something that we have seen with Spotify can improve its ads. Facebook and YouTube as they dealt with other controversies. Reported monetization, that analyst will. But we'll likely hear more about all of this in just a minute. And speaking of advertising, there hasn't been any. When Spotify reports its earnings, that's coming up. A word of advertiser boycotts, something that we have seen with on Wednesday afternoon. And guys, we just have to remember how valuable Rogan is to the streamer. They are reportedly paying him all of this. About $100 million for their deal.
And that's the key, isn't it, Julia? To me, it seems like this isn't about
valuable Rogan is to the streamer. paying him
sponsorship because
about $100
podcasts,
million.
pure podcasts, were about distributing MP3 files with RSS feeds. You can't really censor that. This is about money. This is about Spotify saying we want Joe Rogan exclusively. And some artists on the platform, musicians, saying we don't like that you're using RSS feeds. You can't really censor that. This is about your platform for this. It's interesting. Joe Rogan in the past said healthy young people and children. This is about Spotify saying we want Joe Rogan exclusively. Children don't need vaccines. That's one of the things that and some artists on the platform, musicians, people are upset at him for. He also promoted a claim that lockdown you're using worsen your platform for this. It's interesting. Joe Rogan in the past said healthy young people and children in the spread of infections, and he said he's going to make a couple of changes. Don't need vaccines. That's one of the things that right. He said he'll do more research. People are upset at him for. He also promoted a claim that lockdown before these appearances of controversial guests, and that he'll also have somebody to counter worsen. Controversial guests more close to those things. It sounds like he's getting a little bit more traditional, perhaps. You know, he says, oh, I book all my own guests. These are just conversations. When you're getting paid $100 million, that's a harder case to make.
Well, yes, no, he does sound like he's willing to make changes to avoid getting in trouble with his boss, with Spotify, about the type of ideas and potentially dangerous misinformation he has been putting out there. I mean, I think it's
controversial guests more close to those things. It sounds like he's getting a little bit more traditional, perhaps. You know, he says, oh, I book all my own guests. These are just conversations. When you're getting paid $100 million, that's a harder.
It's worth noting that there were nearly 300 signs. Well, yes, no, he does sound like he's willing to make changes to avoid getting in trouble with his boss that sent a letter to Spotify saying this is dangerous, potentially dangerous misinformation he has been putting out there. I mean, I think it's this is going to have a real impact, and it's going to continue to have a real impact on the country if you don't really prevent him from noting that there were nearly 300 signs. Spreading this misinformation. So I think it's going to be interesting to see the balance here. Rogan seemed a little bit chastened in that video, but you also have to raise this question, you know, Section 230. Section 230 prevents platforms like Facebook, technology companies, from being liable for the content spreading this misinformation. So I think it's going to be on their platform, but is this a difference? It seemed a little bit chastened in that video, but you also situation because Spotify is paying Rogan directly, so they're really more of a Section 230 prevents platforms like Facebook, technology companies, from being liable for the content media company in this situation.
Yeah, Julia, it's a great point that you bring up Section 230
on their platform, but is this a difference?
Sort of complicating that conversation even more here. And as you mentioned, the stock is
situation because Spotify is paying Rogan directly, so they're really more of a
Up more than 10% today. So we're going to
Media company in this situation.
Yeah, Julia, it's a great point that you bring up Section 230. Stick with this story and other streamers that have been hit hard since November. Netflix sort of complicating that conversation even more here. And as you mentioned, the stock is Netflix is up this morning, but it has lost nearly a third of its value year to date. Up more than 10% today. So we're going to subscriber growth slows. Our next streamers that have been hit hard since November. Guest upgrades both Netflix and Spot to buys, calling them undervalued and high this morning, but it has lost nearly a third of its value year to date. Highlighting other subscription names like Roku and Sirius. Joining us now, Citi Research's Jason Bazinet. Jason, good morning to you, and it's great to have you. I want to first start with this Rogan controversy and the idea that it hasn't yet affected the share price. But is there a point or an artist like a Taylor Swift taking down her music that you think would affect Spotify user numbers and subscriber growth?
The catalogs are so unbelievably diverse that I think it'd be difficult for any individual artist or even a handful of artists to sort of impinge upon any streaming provider's growth. So no, we're not nervous about it.
And you're not worried about that snowballing as well. I mean, this started with Neil Young and others have followed suit. And I guess, my question about Taylor Swift, it could be any number of them. But is there a point where you think even advertisers would start to get concerned?
I'm not sure. I guess there is a breaking point when we see this, but as we've followed a lot of ad-based names over time, more often than not, these controversies blow over and they end up sort of not impacting the fundamentals. And I think the market is sort of saying the same thing today, that they expect most of this will blow over and is really untethered from something that could have impacted the stock.
Jason, taking a broader view at these platforms, it seems like there's this thing happening where if you want to be a mass market content platform, you need algorithms to do a lot of the sorting work for you. But also, if you want to win, then you need celebrities. You need big names on the platform. You need hit shows if you're a Netflix. And there seems to be some tension here, right? I'm thinking Dave Chappelle with Netflix, now Joe Rogan with Spotify. Maybe the need to have certain winners who control their own narrative can be at odds with the desire to be hands-off overall. Do you think that's an issue that investors need to factor in down the road?
I'm not so sure. Usually those tentpole franchises, whether it's films or an individual, end up helping gross additions. What ends up being far more dispositive for the equities is the churn rate. And we haven't really seen, churn rates get impacted by any individual. So you could see a little bit of an impact on the gross additions that could moderate sort of the growth, but really churn is far more important. And I would say at the valuations that a lot of these companies are trading at now, there isn't a lot of growth embedded in these names, or growth expectations, I should say.
Right, and that's, prior to the Netflix print, which was difficult, as we all know, there was a growing sense that trading on sub numbers, user metrics, churn, is increasingly difficult, and it should be more about margins and pricing, which is a different way of thinking about these names. Are you going that direction?
100%. So, one of the things that we do is we look at the ARPU and the churn and the customer acquisition costs. And if you bought these stocks, let's say back in August, what you were underwriting if you bought the share was essentially a doubling of the subscriber base. It had to double, otherwise you were going to lose money on the stock. Today, where Spotify and Netflix trade, you need no growth in the sub base. And that's why I think you're seeing some of this reflexive bounce. And that's what caused the upgrade. I think these are pretty interesting entry points.
Jason, I want to ask you about this idea that content spend is increasing every year and that it could be sustainable even at these high levels. What might turn or even halt that trend? And I ask, as the Wall Street Journal article today takes a look at some of these viral streaming hits that are lasting less time, they're more viral, and this sort of push for quality. Does content spend stay at these high levels?
Well, I think what you're asking is this a good business or not? And that's certainly a debate that's raging on Wall Street. Are these good businesses? And the answer is we really don't know until we know how many players are going to be participating in these businesses. So if we live in a world where there's just 2 streaming video providers, that's going to be a great business for the 2 that have, I use the phrase, crossed the Rubicon from the linear business to streaming. If we end up in a world where there's 6, it's going to be more challenging. And so what the street is saying right now is go ahead and spend more money, get more subs, build a financial moat around your business. If we end up where a lot of other media firms end up crossing the Rubicon as well and stand up a real DTC business, then you might see a moderation in content spending, but not now in the narrative. It's too early.
So how do you look at, say, YouTube backing out of original content and its impact, perhaps positive, on
right now is go ahead and spend more money, get more subs, build a financial moat around your business.
Netflix, and then Apple and Amazon with their huge
real DTC business, then you might see a moderation in content spending, but not now in the narrative. It's too early.
So how do you look at, say, YouTube backing out of original content and war chests, the likelihood of that positive on them remaining in this game with that spending long term? Amazon with their huge. How do those players, and of course both of them are in music as well, affect, say, Netflix and Spotify?
I would say more peripheral. I mean, if you look at
war chests, the likelihood of
the quantum of spend that's going on within the traditional media firms, they're all adjusting their spend to go more direct to consumer, spending more money on streaming. Those other big tech companies that you referred to, while they're large companies, if you look at the quantum of the spend on video in the DTC ecosystem, it's actually quite limited.
Jason, thanks for your insights. We hope you'll join us again soon. Jason Bazinet from Citi.
Thank you.
Still to come, the CEO of Micron is on with us after the break. Tech Check. Still to come, the CEO of Micron is on with us after the break. Tech Check is just getting started.
Time now for a gut check on Citrix, set to be taken private in a $16.5 billion acquisition. That's according to the Journal. Evergreen Coast Capital Corp and Vista Equity Partners buying the cloud computing firm for $104 a share, looking to merge Citrix with another data management software company. Shares are sinking this morning on that news, down nearly 4%, John.
Yeah. Meanwhile, 2021 was a record year for semiconductors. Global chip sales jumping 25%, topping $500 billion for the first time. Shortages continue to squeeze the industry, but are projected to boost revenue by 9% this year. Joining us now to talk about expectations for the industry, Micron Technology CEO Sanjay Mehrotra. Sanjay, good to see you. Now, this is an interesting time. We talked about, just mentioned the shortages last year. And at the same time, there's legislation that could build capacity here in the U.S. Why is this moment important for chips?
It is extremely important because it highlights the importance of semiconductors, John, in all our economic growth, national security considerations. And if you look at, John, over the course of last 20 years, overseas governments have really invested and supported bringing semiconductor industry onshore in their countries. And U.S. government has not provided the support over the last 20 years. As a result, if you look at memory manufacturing, we only have 2% of global memory production here in the U.S. Of course, we need to reverse this trend. And this is where the efforts of President Biden, Secretary Raimondo, and bipartisan coalition on the Hill are extremely important in terms of securing long-term semiconductor memory leadership in innovation and manufacturing, and U.S. leadership in innovation and manufacturing. And here, Micron is very well positioned as the only U.S. company that manufactures semiconductor memory and storage. We announced, John, last year that we would be investing more than $150 billion over the course of the decade to address the growing need of memory and storage in the data economy today. So, John, we are well positioned to address this. We are very appreciative of the efforts and the recognition of semiconductors. We need to bring more manufacturing to the U.S. We need to drive U.S. semiconductor leadership in innovation. This is going to be important for jobs and for economic growth.
Sanjay, I believe TSMC and Samsung have talked about building more manufacturing capacity in the U.S. Certainly Intel lately, with just that $20 billion announcement in Ohio alone, it could turn out to be more, has talked about it as well. How do you at Micron look at the investment potentially in U.S. manufacturing, and are any of those other companies' future capacity interesting to you? I believe TSMC and Samsung
memory manufacturing
building more manufacturing capacity in the U.S. Certainly Intel lately, with just that $20 billion announcement.
Is hard stuff, and Micron over the 43-year history has really driven.
How do you at Micron look at the investment potentially in U.S. manufacturing?
Driven the tremendous innovation and manufacturing expertise. Memory is at the leading edge of semiconductor memory, and within that, Micron is leading. I would like to point out here, Micron has manufacturing here in Manassas, Virginia, and we actually, even pre-pandemic, invested in expanding that clean room there to meet the growing needs for memory demand in automotive and industrial segments. In fact, that clean room, that fab expansion, completed construction in 2021. We began ramping that into production late in 2021, and we'll continue to ramp that through 2022. So point is, John, that Micron has been investing over the course of last few years in continuing to increase its manufacturing capacity, of course, driving memory supply growth in line with the demand growth. We have made those investments here in Manassas, Virginia, as well as in our global footprint as well. So we have been proactive in driving prudent growth of our supply to meet the growing needs of our customers, from data center to the intelligent edge to smart user devices.
So with all that in mind, Sanjay, I wonder, do you think that the industry supply crunch, as we knew it in the depths of 2021, driven largely by COVID, is ending, is over, will be over soon? Where are you on that?
No question that there are certain pockets of shortages that are certainly continuing in the industry. And we said in our last December earnings call that we expect that these shortages will continue to ease throughout 2022 timeframe. And of course, industry has invested a lot. Micron has invested a lot in manufacturing capacity in terms of investing in technology transition capability to grow the supply, as I mentioned earlier. Carl, this year, our CapEx will be at record levels. Last year was a record level too, and this year we are growing it by nearly 20% compared to last year. All of this going into driving leading edge technology transition to meet the growing needs, again, across a wide range of markets, from data center to smartphones to, of course, PCs to consumer and industrial devices. What's happening is that the trends of AI, 5G, autonomous, they're all driving greater need for memory and storage. And this is why we think that for the rest of this decade, memory and storage will grow faster than the semiconductor industry on an average.
Sanjay, it's Deirdre. Good morning. You're shutting down your Shanghai DRAM operations. Can you talk about why you made that decision and how you're viewing the Chinese chip landscape as a whole with this continued investment from Beijing? Is it becoming more of a competitive threat?
So Deirdre, what I would tell you is that Micron is a global company. And of course, as a global powerhouse of a company, a large company, we of course make adjustments in our footprint of resources for development. These kind of restructurings are a common course of business. And in the Shanghai Design Center, while our DRAM team is being de-emphasized in order to integrate it better and streamline our operations better with other parts of our global R&D centers, I would point out that the Shanghai R&D Center continues to be an important area of development for our other projects. And of course,
Sanjay,
China is an important market for us.
It didn't have anything to do with IP rights and talent being poached by Chinese chip makers?
Well, we have teams all across the world. And it is important for us to make sure that we are optimizing our R&D developments appropriately. Of course, keeping in mind our IP protection, as well as making sure that we are bringing new technologies faster to the market. And that global footprint of R&D between Asia, between Europe, between US, multiple locations in US, has led us, Deirdre, to now have the most advanced technology in DRAM in high volume production ahead of anybody else. We call it our 1-alpha DRAM. And we are doing the same thing on the NAND side with our 176-layer technology. We have the best in class technology in high volume production ahead of others. So Sanjay, we are managing our business prudently, keeping long-term objectives in mind.
Sanjay, we recently saw Peloton misjudge demand for its product. Clearly, Peloton doesn't make chips, but as I'm talking to different leaders, different CEOs in the chip sector, I keep hearing about demand shifting, say, from lower-end process technology to higher, about companies competing on a technological basis for the future around 5G, around AI. Should investors be thinking about maybe this rising tide isn't going to lift all boats equally, but some players with certain differentiated technologies might succeed more than others?
Certainly leading edge technology is going to be key in order to secure supply of products for all industry applications. Of course, there will continue to be a demand for legacy technology as well. And Micron continues to build.
Maybe this rising tide isn't going to lift all boats equally, but some players with certain differentiated technologies.
Those as well, but just remember that the investments that happen in the industry are on the leading edge technology front. And this is why the efforts that US is making with the CHIPS Act and the investment tax credits is critically important to make sure that chips and investment tax credit and all of this funding gets across the finish line soon so that we can bring more leading edge technology with companies like Micron having the opportunity to bring a substantial portion of our future investments that happen in the industry are on the leading edge technology front. And this this is why the efforts that investments in leading edge technology onshore in manufacturing here in the US. So leading edge technology is going to be important, and here Micron has done a nice job in continuing to build the finish line soon so that we can bring more leading edge technology with companies like Micron having the opportunity to build its portfolio, position our product portfolio across a wide range of end market applications. And I do believe that companies like Micron are well positioned to benefit from leading edge technology and the trends of AI, 5G, all this data economy driven applications.
Well, we're going to keep our eye on what Washington does with that, as I'm sure you will as well. Sanjay Mehrotra from Micron, thank you.
Thank you, John.
Still to come this morning, why one Wall Street firm says buying a firm now may get you paid later. The analyst behind that call will join us in just a bit. We're back in a couple of minutes.
All this data economy driven applications.
Well, we're going to keep our eye on what Washington does with that, as I'm sure you will as well. Sanjay Mehrotra from Micron, thank you.
Thank you, John.
Still to come this morning, why one Wall Street firm says buying a firm now may get you paid later. The analyst behind that call will join us in just a bit. We're back in a couple of minutes. Welcome back to Tech Check. I'm Carl Quintanilla with Deirdre Bosa and John Ford. In just a bit, we're going to look at the ARK funds and the willingness of some investors to stick with Cathie Wood after a rough start to the year. First, though, let's get a news update with Rahel Solomon. Hi, Rahel.
Hi, Carl. Good morning, and here's what's happening at this hour. Shares of L3 Harris are posting some of the biggest losses on the S&P 500. The aviation and defense company beat earnings estimates, but profit guidance was on the light side. And the company says that revenues will be impacted by supply chain issues for the first half of the year. Elevator maker Otis Worldwide also posting mixed results and giving guidance largely below forecast. But its stock has erased early losses and now up almost 2%, close to 2% there. Goldman Sachs has cut its GDP forecast for this year by more than half a percentage point to 3.2%. Goldman says that the slowdown will be abrupt this quarter as fiscal support fades and Omicron's impact is felt. And Angie teaming up with Walmart to provide help on home projects. Angie Professionals will soon be available through nearly 4,000 Walmart stores and online nationwide. Its stock has erased early losses and now up almost 2%, close to 2% there. Goldman Sachs has cut its GDP forecast for this year by more than half a percentage point to 3%. Angie shares are up 9% on this news. Deirdre? As fiscal support fades and Omicron's impact is felt. And Angie teaming up with Walmart to provide help on home projects.
Rahel, thanks so much. We're going to get to software now. The iShares software ETF sliding 20% in the past 3 months. We've talked a lot about it, but we're still seeing strong earnings from the likes of Microsoft, ServiceNow, Atlassian, and Qualtrics. The results boosting Morgan Stanley's view that the Thanks so much. We're going to get to software now. The iShares software ETF sliding 20% in the past 3 months. We've talked a lot about it, but recent sell-off is disconnected from underlying fundamentals. Joining us now to strong earnings from the likes of Microsoft, ServiceNow, Atlassian, and Qualtrics. The results boosting Morgan Stanley's view that discuss the sector. GGV Capital Managing partner Jeff Richards. Jeff, good morning. You have said a similar thing. Recent sell-off is disconnected from underlying fundamentals. Joining us now to you just need to know where to look for this value. And we're seeing the NASDAQ up nearly 1.8% today. Partner Jeff Richards. Jeff, good morning. You have said a similar thing. Pointed out that some of the names you talked about a few weeks ago when you were on the show have all know where to look for this value. And we're seeing the NASDAQ up. Already bounced. I guess it leads to the question, have we already seen a bottom? Where's there still opportunity?
Great question, Deirdre. As you mentioned, a couple weeks ago, we were sort of at the depths of panic around software and cloud. And since then, we've seen Microsoft, we've seen Qualtrics, a bunch of great earnings come out. Cloud is strong and no reason to be shy about hopping in at some of these levels. I'm not a market timer. I can't call the bottom, but it sure feels like we saw a lot of names get very cheap, at least by historical standards. And particularly when you look at the growth rates going forward, one of the things I'm bullish on is a lot of the recent IPOs have just incredible growth rates of north of 30, 40, 50, 60%. Those growth rates have been accelerating, even for companies like Microsoft and Amazon to accelerate growth in the cloud. So we're bullish. And as long as you've got a 3 to 5 year outlook, no reason not to be scooping up shares of names that you like.
Jeff, you pointed out on Twitter that Asana's founder, Dustin Moskovich, has been buying shares of his company. You called it impressive. You and I have talked offline about founder insider sales. How do you think that investors should look at this? I'll give 2 examples on the other side, a Peloton and a Palantir, where you have seen insiders sell a whole lot of shares. Does it matter? Should it matter to investors?
Well, Dustin's a little bit of a unique case, right? He's worth, I believe, over $20 billion, given he was one of the original co-founders of Facebook. But I think it's got to be a strong signal for employees. When your founder and CEO is doubling down, even at some of the higher levels, and then purchasing more. I think he's purchased several $100 million worth of stock over the last few months. it's a bullish signal. And we've seen insiders at other companies in the last few months. I noted recently one of the directors at Smartsheet was buying shares. So it wouldn't shock me if we come out of this January, February time period and we find out that a lot of hedge funds were scooping up shares, as well as insiders who were bullish on the long-term prospects for these companies. And obviously we saw Bill signal for employees. You know, when your founder and CEO is doubling down, even at some of the higher levels, and then purchasing more. I think he's purchased several $100 million worth of stock over the last few months. It's a bullish signal. And we've seen insiders at other companies in the last few months. I noted recently one of the directors at Smartsheet was buying shares. So it wouldn't shock me if we come out of this January, February time period and we find out that a lot of hedge funds were scooping up shares, as well as insiders who were bullish on the long-term prospects for these. Stockman jumping big with Netflix last week, and who knows, maybe that'll be a signal that others were following as well.
Yeah, I mean, yeah, the insider buying is we'll keep our eyes on it, Jeff. But I wonder. Can you envision a longer-term scenario where business is great?
Stockman jumping big with Netflix last week, and who knows, maybe that'll be a signal that others were following as well.
But valuations continue to get. We'll keep our eyes on it, Jeff. But I wonder. Compressed by quantitative tightening, a process that's not going to. Can you envision a longer-term scenario where business is great, ostensibly end this year or next year or the year after that?
Yeah, great.
But valuations continue to get.
Great point, Carl. I mean, look, if I told you a few years ago.
Compressed by quantitative tightening, a process that's not going to.
We were going to come out of a quarter with record low unemployment, 3.9%, and over 6.
Ostensibly end this year or next year or the year after that.
Yeah, great. 6% GDP growth, and we were coming out. Great point, Carl. I mean, look, if I told you a few years ago. We were going to come out of a pandemic, I think you'd think that was a pretty bullish signal for equities. However, obviously we've got rising interest rates and inflation. Inflation's a big concern. You know, I was at a car dealership this weekend. They were marking up cars $15,000, $20,000, which is just incredible to me. So hopefully we can solve for inflation, and then otherwise, I believe we've got a very strong economy ahead of us. And let's not forget small business, which is the lifeblood of America. 60% of Americans work for a small business. Hopefully small business comes roaring back out of the. Obviously, we've got rising interest rates and inflation. Inflation's a big concern. You know, I was at a car dealership this weekend. They were marking up cars $15,000, $20,000. Pandemic, and software and technology companies that sell to small business could benefit in a big way. Companies like Square and Toast and Shopify and others.
Jeff,
hopefully we can solve for inflation, and then otherwise, I believe we've got a very strong economy ahead of us. And let's not forget small business.
Software is a really big category, and maybe investors can get some help from you in sort of filtering what's worth looking at. Growth is one thing. What about operation?
Pandemic, and software and technology companies that sell to small business could benefit.
Operational discipline. What about ideas like product-led growth, where Atlassian has a pretty unique model? What do you look at in these companies to determine? Software is a really big category, and maybe investors can get some help from you in sort of filtering who's got real strength going forward, besides the top line. Percentage growth.
It's such a.
What about ideas like product-led growth, where Atlassian has a pretty unique model? What do you look at?
Great question, John. And you mentioned product-led growth. What that does is it reduce.
Who's got real strength?
Companies' cost to sell and market their product.
Percentage growth.
It's such a. Right. You talk about Zendesk or Atlassian, some of these product-led growth companies, which. Great question, John. And you mentioned product-led growth. What that does is it reduce. Means the product is getting sucked up in. companies cost to sell and market their product into an organization, and folks are buying more of it on their own without having to have right? You talk about Zendesk or Atlassian, some of these product-led growth companies, which sales rep, for example, go visit. Other examples I'd give would be the means the product is getting sucked up in. Low code, no code space with Monday, Smartsheet are buying more of it on their own without having to have Asana. We talked about those sales rep, for example, go visit. Other examples I'd give would be the earlier. And then, you know, the other metric that we love and folks in the investment community love is code, no code space with Monday, Smartsheet, NRR, net revenue retention. If a company's got 120, Asana, we talked about those 20% net revenue retention. It means they essentially start the year knowing that, you know, the other metric that we love and folks in the investment community love is their current customer base is going to grow 20%. So that's how you're seeing these companies compound with 30, 40, 50, 60% growth rates. They're not only getting customers to renew at a higher level, they're also adding new book of business throughout the year. It's an incredible thing that the software industry has that most other industries don't have with the subscription model. And you're seeing that even with companies like Google, Microsoft, and AWS, Amazon with AWS, right? As those businesses grow that are on those platforms, the net revenue retention on those platforms is over 100%. It's a beautiful thing and a reason to be bullish long-term on software.
Yeah, you're providing sort of a playbook right here, Jeff. I wonder, do you think that some of the software companies, or many of them, should have done more with their currency when their stock prices were at higher levels? Was there a missed opportunity in terms of M&A or raising capital or more capital?
Well, you might have been on that Twitter thread last week, Deirdre. Businesses grow that are on those platforms. The net revenue retention on those platforms is over 100%. It's a beautiful thing and a reason to be bullish long-term on software. A lot of folks asking that question. I think one of the challenges was the public currencies.
Companies, or many of them, should have done more with their currency when their stock prices were at higher levels. Was there a missed opportunity in terms of M&A or raising?
Were high, but so were the private market valuations. Well, you might have been on that Twitter thread last week, Deirdre. And we haven't really seen private market. A lot of folks asking that question. I think one of the challenges was the public currencies. Valuations come down yet. They usually lag the public market by 3 to 6 months. Maybe we will. But man, there's more private equity and venture capital dollars at work, more dry powder than there ever has been, record amounts of venture capital invested last year. So it may take some time for those public companies, even if they are trying to be aggressive and go shopping, to find companies that are willing to sell when they've got ample capital available to them and valuations have been attractive on the private side as well. Obviously, we saw the Citrix deal with Vista today. I don't think anybody would put Citrix in the high growth software category, but maybe it's a sign that we're going to start seeing some of these private equity firms scoop up companies that are now trading at 10 or 15 times forward sales that were at 25 or 30 just 6 to 12 months ago, or at least try to.
Jeff, it's great to have you. Thanks. We'll talk to you again soon. Jeff Richards of GGV.
And coming up, we're going to chop it up on the Cathie Wood trade as a favorite pick. Tesla gets an upgrade. Credit Suisse goes from neutral to outperform, saying they're hard-pressed to find a company that checks all the boxes like Tesla does. $1,025 price target there. Stock up about 9%. We're back at 2. $1,025 price target there. Stock up about 9%. We're back at 2.
Welcome back. Kathy Wood's ARK Innovation Fund up 7% this morning, but having a tough start to the year, as you know. Our Dominic Chu's taking a look at how poor performance has led to some outflows. Hey, Dom.
So, Carl, it hasn't just been the last few weeks. It's been the last several months here, ever since we saw the peak of this particular ETF, the ARKK, the ARK Innovation ETF, going all the way back to the early part of 2021. For many investors out there, it's about the idea of having to stomach what's been pretty much a 50% drawdown in terms of the overall value of this particular ETF from the peaks that we've seen all the way down to where we are right now. That has, again, led some traders and investors to talk about this notion that price and sentiment go hand in hand. As prices go lower, sentiment kind of drifts along with it. If you look at the fund flows so far just in January overall, it seems rocky, roller coaster, but on balance, the larger down days have really taken more of an influence over the fund flows than some of the up days that we've seen. To that end, this is the bar chart showing the flows just so far this year-to-date period, this month-to-date. If you look at the kind of contextual moves that we've seen in some of these fund flows, on a one-day basis on yesterday or the previous session, we've seen about an $86 million outflow. On a one-week basis, it's still negative, down about $50 million. Over the last month, down $371 million. And on a year-to-date basis, again, since the beginning of this month so far, roughly about $234 million to the downside. Now, I'm going to take all those away, Bo, and then focus on the one-year number. They've still taken in close to $1.4 billion just in inflows into the fund during that time. If you look at it, it's going to come down to a lot of chatter with regard to the holdings that this fund has, because many of them have seen very large drawdowns. We've talked about Tesla a lot. Zoom Video, Teladoc, Roku, and Coinbase. These are the 5 top holdings in this particular ETF, and we know from many of these growth-oriented stocks, they've seen precipitous declines. Whether they find the bottom and rally here is going to be a big call, but a lot of folks are actually using this ARK ETF as a way to kind of play that basket rebound trade. And I would point this out, guys, and we know this, these 5 stocks make up roughly 33%, a third of the overall ETF. So as these stocks go, so goes the ARKK, guys.
Meanwhile, Dom, it does nothing to stop the ongoing conversation of what percentage of investors are underwater. Same conversation we have with Bitcoin, and whether or not that number is large enough that it would inhibit further buying down the road.
So that's a great point. So a lot of the talk these days now is about whether or not folks had been buying in towards the highs that we saw back in February, March of last year. This is now a conversation where many of the traders and investors I talk to that actually traffic in this particular fund, they start to talk about this notion of dollar cost averaging, right? And this idea that as you buy your way down, you're trying to lower your cost basis, playing for that eventual bounce back. Now, I'm not sure what that says about sentiment there, but there is a contingent of folks out there who really believe that these stocks have a long-term transformational effect on the overall way that we live lives and the overall market. So they're turning to this as a way to kind of say, hey, you know what, on the way down, if we are kind of legging into it, averaging into those positions, that might pay off down the line. But I would say this, the idea that those top 5 holdings I just showed you have been beaten up as much as they are, with each of them, with the exception of Tesla, Deirdre, all of those stocks that I mentioned between Teladoc and Roku and all those have implied analyst upside target prices that are anywhere from 70 to 110% of their current values right now. So it remains to be seen whether those bounces can stick.
Yeah, it certainly depends on your investment horizon. We should note as well that the NASDAQ now up over 2%. A lot of those names that Dom highlighted, the high growth complex, rebounding hard today. As we had to break, check out the biggest laggers on the NDX to start the year. Moderna, Netflix, Peloton, some of the biggest losers. Tech Check is back in just a moment. Certainly depends on your investment horizon. We should note as well that the NASDAQ now up over 2%. A lot of those names that Dom highlighted, the high growth complex, rebounding hard today. As we had to break, check out the biggest laggers on the NDX to start the year. Moderna, Netflix, Peloton, some of the biggest losers. Tech Check is back in just a moment.
Let's get a double-header gut check. Coinbase and Shopify, both stocks jumping this morning as risk comes back on a bit. Also today, Coinbase announcing Shopify CEO Toby Lütke will join Coinbase's board of directors. Coinbase CEO Brian Armstrong writing that with the addition of Lütke, the company hopes to unlock crypto's potential to increase economic freedom in the same way Shopify democratized online commerce. Both those stocks having a rough run lately, down 35 to 40% in the last 3 months, but each with only one sell rating on the street. We'll be right back. Will join Coinbase's board of directors. Coinbase CEO Brian Armstrong writing that with the addition of Lütke, the company hopes to unlock crypto's potential to increase economic freedom in the same way Shopify democratized online commerce. Both those stocks having a rough run lately, down 35 to 40% in the last 3 months, but each with only one sell rating on the street. We'll be right back.
Let's turn to Affirm. Shares are surging 17% on Friday after our next guest upgraded the fintech firm from neutral to buy. Bullish on valuation, the increased use of buy now, pay later over the holidays did cut the target from 110 down to 75 on more macro concerns. Joining us this morning is the analyst behind those calls, D.A. Davidson senior research analyst Christopher Brendler. Chris, it's great to have you back. We actually had a couple of upgrades last week, yours included. Some of them revolved around the idea that we might get some good GMV guidance. Is that your view?
Yeah, absolutely, and thanks for having me. It's obviously been a little bit of a rough quarter from a stock perspective, but that kind of belies the fundamental performance. Buy now, pay later, and Affirm's installment loan options really starting to gain traction with consumers, especially during the holiday season. This is, I think, the year that last year was the year that BNPL came of age. Consumers' awareness, merchant adoption, both rising significantly. And Affirm has some really big partnerships that are ramping this quarter that we think will put a lot of upside potential to the GMV numbers, mostly Amazon and Shopify.
Where are we in sort of evaluating credit risk, delinquency risk? Are those trends stabilizing to a point that you think is safe?
I wouldn't say stabilizing. I think that's our biggest concern as we watched the stock run up last fall and stayed on the sidelines was credit risk and how it wasn't really being appropriately discounted in the valuation. But the valuation has improved dramatically, and I think it's more sort of taking into account the credit risk that exists in Affirm's model. But we're still at for very, very good times for consumer credit, almost record lows in terms of delinquencies and losses. And it will get slowly normalized from here, but I don't think we're going to get some sort of really big spike, absent a macro issue. So I think it's going to be a gradual normalization. And given the top line growth we expect for Affirm, we don't see it impacting numbers anytime soon.
Hey, Christopher, let me ask you a broad question, and that is, does every fintech company need or should have a crypto strategy? You see sort of this broad range from Shopify CEO joining the Coinbase board, and then you have, Klarna on the other end sort of telling John Ford, I think it was last week, that they didn't embrace Bitcoin, and it's looking bright at the moment as we see the price of Bitcoin slump. So I wonder, does crypto factor or not factor into the way you value fintech companies?
I don't say it factors into, but it is very important. I think that it's still early days, and don't get focused on the price. Look at the adoption, look at the progress that we're making with crypto adoption across companies, retailers, consumers. It's becoming a bigger part of our lives. The transformational technology behind the blockchain and ability to do trustless transfer will only continue to grow as more and more developers and more capital flows into the space and takes advantage of this technology. I don't think payments is really the first or best use case. I think we have some really strong payments rails out there, and if you're especially in a developed world with cards and other e-wallets, I think it's more just the technology itself creates a lot of different possibilities, and you want to be involved. For fintech companies, especially companies like Affirm, who has also talked about adding crypto, it's just a way of increasing consumer engagement. It's sort of the ability to trade or buy crypto like the Square or Cash App has, or PayPal's wallet's added. They're just trying to increase consumer engagement, get them to use that app on a daily basis. So I don't think it's a huge part of the strategy, but it certainly can be incremental.
Christopher, talking strategy here, do Affirm and Klarna, for example, have to become super apps and starting points for commerce in order to win long term? Because I notice they're working on that. And how much of their long-term success actually depends on the product level data that they're getting about consumer preferences and their ability to then adjust their approaches based on that?
That's a great question, and one I still don't think we know the answer to. Certainly the biggest, I think, catalyst for Square's purchase or the Block's purchase of Afterpay is that consumer engagement and becoming more of a super app and getting people to use Cash App on a daily basis. For a company like Affirm, I think they have a really, really strong value proposition. They're not really in that merchant-funded buy now, pay later space that's so crowded. They do a lot more consumer finance loans, and they're obviously the success they're having with Amazon and Target and Walmart and Shopify, sort of points to their differentiated model. I think it's more additive to them, but in terms of the valuation and the stock, for me, Affirm's ability to transform into a super app and start getting consumer deposits and acting more like a checking account for consumers is just icing on the cake. They have a tremendous opportunity in their core business. If they're able to transform into a super app, especially given the funding requirements of the buy now, pay later model, that would be just a huge, I think, upside potential, not necessarily something they need to do, more of an upside case.
Going to be fascinating to see what they report. Chris, appreciate that very much on the heels of your upgrade.
Appreciate it.
Meanwhile, NASDAQ about to avoid its worst ever January. We're back after this.
It's just icing on the cake. They have a tremendous opportunity in their core business. If they're able to transform into a super app, especially given the funding requirements of the buy now, pay later model, that would be just a huge, I think, upside potential, not necessarily something they need to do, more of an upside case.
Going to be fascinating to see what they report. Chris, appreciate that very much on the heels of your upgrade.
Appreciate it.
Meanwhile, NASDAQ about to avoid its worst ever January. We're back after this. Today is the last trading day of January and the end of what's been a historically bad month for tech stocks and the NASDAQ. Here's a rewind. Tech continues to sell off in 2022.
Tech sinking yet again.
That's its worst January performance on record ever.
Is more volatility ahead?
Well, unless you think inflation is done and unless you think the Fed is done, it's hard to imagine that this is done.
It's certainly been a rough couple of weeks, and tech stocks have certainly taken a hit.
Across the basket, the cloud industry and software holistically has just been hammered.
You're just seeing brutal selling across semi, software, fintech.
This is something that I think we're seeing exacerbated just by the anticipation of inflationary fears, Fed tightening.
Tech investors not the only ones feeling the pain this week.
It's been the worst start of the year for tech billionaires in recent history.
The tech sell-off does rear its head.
We're still trying to figure out, have people sold enough of the risky winners of 2021 and 2020?
The question we all want to know.
We'll see how they work it out.
Any doubt this tape moves fast here, John? NASDAQ's now up 8% from the January 24th low.
Yeah, and now investors should know this can happen. The question is, will it continue to happen? Will it happen again, or is this pop the end of it?
Yeah, and I mean, to think that last week with all the volatility, we ended almost where we began. What a month it has been, Carl, to start the year.
Yeah, and we're going to get through AMD and Ford and Meta this week, along with the jobs number. Let's get to the half.
All right, Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. An impressive rebound for stocks or uninspiring? That is the debate right now as a brutal month comes to a close. So where does it leave your money now? We'll debate that with the Investment Committee. Joining me for the hour today, Liz Young, Steve Weiss, Jim Leventhal, Joe Terranova. Let's check stocks as we always do, wrapping up what has been a brutal month, as you'll notice, and you know it by now for sure. NASDAQ is the big bouncer today, up nearly 2.5%. It's trying to avoid the worst January ever, and at least at the moment, by 4 or 5 points or so, it's doing just that, recapturing 14,000 today. Dow's good for 116, 1/3 of 1%, 10-year note yield. Lots of focus there. It will be for the weeks and months ahead, of course. 178 on the 10-year note yield. Joe Terranova, so where does this leave us now, heading into a new month?
Well, I think this is clearly today, last trading day of the month, the most obvious rebalance that I've seen in recent memory. You're seeing all of the sectors in the equities market that have been underperforming year to date: consumer discretionary, communication services, technology. They're leading the market. The other side of that, financials, industrials, energy, underperforming the market. And then you have the hyper growth story coming back once again. So within that hyper-growth story, you could look at a Twilio, a CrowdStrike, Palo Alto Networks. Those are names I'd be focused on. But what I would do is this, Scott. I think that the bigger picture of this market is that you posted a low in January, and the market is pattern matching exactly 2016. If you have the chart back in EC, please show what I gave to you guys before, the producers. 2016, you had a sell-off. November peak, market sold off aggressively in January, retest in February, and that was the best outcome because the market was clear sailing higher from there. So I clearly think what's going on here over the next 10 days is you may get the retest of the bottom from last Monday, you may not, but I think there are names that you're going to go in right now and be able to buy, and you're not going to get hurt, but they're not the names that are rallying today. They're the names where you've got the free cash flow generation present, they're high quality in their nature, and a lot of them are large cap. Remember, Scott, small caps broke through Monday's low on Friday, so I don't see the all clear for small caps. It's large cap, it's quality, it's the big mega cap names we know.
So, Liz, you know, we're going to enter a new month, and we're still asking ourselves this question of whether we bottomed last Monday. You know, we've had a nice rebound since, and I'm curious to know what you think as to whether this is a sell the rip kind of a market. You've got a nice move in the NASDAQ, as we just showed you. We've had a nice rebound. Morgan Stanley's Mike Wilson today says he's uninspired by last week's price action. We would be sellers of rallies, he said. We remain uninspired by the price action at the index level despite strong earnings prints. We're seeing a classic bear market action, says Mike Wilson of Morgan Stanley. So, in essence, he's doubling down on his negativity. What do you think about that?
So I think last week's action and the big swings that we saw intraday, that's probably over. That was probably as bad as it gets from an intraday swing standpoint. But I don't think we're done with this volatility. You have to look at what's happened in the NASDAQ year to date. We're only 1 month in. And if this move holds today, this would be the 7th day of more than a 2% move in the NASDAQ. That is a lot of days with big moves. The VIX above 20 now for 2 weeks, above 25. So I think last week's action and the big swings that we saw intraday, that's probably over. That was probably as bad as it gets from an intraday swing standpoint. For 6 trading days, I think the VIX stays elevated here. So then the question is, what do you do with your money, knowing that rate hikes are probably coming in March and that we're embarking on a rate hike cycle? If you look at the patterns of what happens in the market leading up to rate hikes and then what happens afterwards, generally speaking, cyclicals do well into the hike, and then afterwards we have choppy markets for about 3 months. If you can wait 6 months out, then things start to strengthen up. You see tech come back in, communications come back in, and things stabilize. But you have to have the stomach for it. So I would stay on that value, on that cyclical trade here for the next 45 to 60 days, and then you have to wait it out. I don't think this volatility is over. The Fed has not even moved yet.
Weiss, are you a believer in all of this, or are you as uninspired as Mike Wilson?
6 months out, then things start to strengthen up. You see tech come back in, communications come back in, and things stabilize. But you have to have the stomach for it. So
Appears to be by the price action in the market last week.
Well, I'm inspired to trade it. So if you recall, I'm sure you do, I sent you and Prashant a text on Friday at 10:17 in the morning, 3:17 my time, because I'm in London. And I said, I think the market's going to go green today. And I said, I'm massively long the Qs. And I stayed long, and I'm going to sell those into the close today because I agree with Joe. It's a massive rebalance. So the world's not changed. As a matter of fact, I think it's going to be the same pattern, the one that Liz mentions, where we're going to be trading it. So it's a trading market. I'm going to keep my core positions, which, by the way, are companies where I believe that they'll continue to generate cash flow, most of them free cash flow in size, and that's where I find value. I also think that you're going to want to own, continue to own, as I do, the large cap growth stocks because they've been defensive and they're going to perform. They're cash rich. So it's going to be a volatile market. It's going to go up and down, but I don't think it's over. Look, you had record multiple expansion from record easy money. You've got to believe that what goes up must come down. So those multiples are going to continue to contract. And days like today and days like Friday only give you opportunity to sell what you regretted not selling the prior week. So, look, I don't think there's any disaster there, but I think it's a trader's market. Joe, I'm sure, is actively trading the futures. I'm with him in trading it. I think that's where I'm going to be while maintaining my core positions.
I guess, Farmer Jim, everything depends on yields, and that will remain the story moving forward if you're trying to get a gauge on where stocks are going to go. Goldman's David Kostin is doing that, says if, real yields move to zero, you could get 4,000 on the NASDAQ. I just don't feel like there's a lot of conviction to say that the bottom was in or there's smooth sailing now, that we overdid it, we're oversold to the downside. That may get you a little bit of a bounce, but I don't find too many believers. Now, maybe we're going to get one in a little while when Adam Parker comes up on the program today, our headline guest, Farmer Jim. I went to you, you were with us almost every day last week, and I started almost every program off with you because of your call that Monday was, in fact, the bottom. Now you've had a week to digest all that. We're putting in a dismal January. Here we come to a new month. There are a lot of things on the table. How do you see it now?
So we're 6% higher than we were last Monday, and I'm perfectly willing to move past the moniker of, the Farmer Jim bottom, because I think where we are now is you have to look forward. And when you bring up yields and when we talk about the Fed, I have to be clear about my position here. I don't think that yields or the Fed are the reason that the market's going to go down. I think those are the reasons why volatility is going to increase. But I strongly believe that you need a catalyst in order to make the market go down. Now, that catalyst could be anything. It could be Russia versus Ukraine. It could be... Wait.
What do you mean?
Finish. Wait, Scott,
I don't get it. No. I'll come back to you. No. I'll come back to you. No, I'll come back to you for a second. Because, frankly, when you say there's no catalyst, you're telling me that a new Fed regime, a more hostile Fed, isn't a catalyst enough, that it has to be some exogenous event somewhere, or a war in Europe now to wake you up?
Scott, yeah, that is what I'm saying. That's exactly what I'm saying. And let me be clear about this. The bull market is intact. Anybody who's calling for a bear market, I think, is absolutely wrong. And you look at the last time that Russia annexed the Crimea, that year, they did it in February of 2014. The S&P was up 13% that year and 12% on average the next 4 years. The point being is that's not what moves the markets. Profit cycles are what moves the markets. And this profit cycle is still intact. All the Fed is doing is increasing volatility. By itself, it's not going to knock the profit cycle down. And as far as, it not being a catalyst or being a catalyst, we've discussed it for the week. It's time to move on. All right, we've got people out there saying 7 hikes this year, 50 basis points in March. I happen to think all of that is ridiculous. And I'm telling you, you need to now look forward at what the next issue is that can knock the market down. It's not just yields in the Fed. You need something else. And this profit cycle is still intact.
I don't know, Joe. I don't know if Farmer Jim spent too much time in the fields this weekend or what, and whatever he was doing there. Because that sounds a little out there to me, Joe, that, ho-hum, the Fed, new regime, they came in all, Powell was all aggressive and hawkish, and Jim says doesn't matter.
Not anymore.
Yeah, I'm with you on that one, Scott. And Jim, no disrespect, but I wish we.
Farmer Jim spent too much time in the fields this weekend or what, and whatever he was doing there.
Stop using the words "the market," right? Because I think using the words "the market" is incorrectly going to lead people to make decisions that are going to be wrong. We all have said volatility is here to stay. Scott has defined the Federal Reserve environment, and let's face it, there's no clarity with what the Federal Reserve is going to do, especially with where the price of oil is. But let's stop saying the market, and let's specifically identify where opportunities might exist. Because I'll tell you what, with the way the tape is trading today, I'm sorry, I don't want to give in to the temptation of buying these high PE, hyper growth stocks or small cap software that on this rebalance are rallying so aggressively. That's not what I want to do. Now, I just told everyone, I think this is 2016. I think you are going to get a retest some point in February, and there's names you could buy. But let's talk about a market of stocks and what exactly we could be buying in that environment. And it speaks to exactly what Steve's talking about, trying to identify companies that are large cap in their nature and have that strength of free cash flow generation. Can I tell you what? I know Kathy Wood has said innovation is on sale right now. No, Scott, quality is on sale right now. And I would absolutely be a buyer of that quality.
Okay, so Weiss, I'm glad you had a little bit of a moment here to digest what Farmer Jim had to say. I purposely didn't come to you right after that because I was afraid you'd come in too hot. And I didn't want that to overshadow whatever message you would have. But let's discuss this. Jim essentially says the Fed is no big deal. It's going to cause volatility, if nothing else. Despite the fact that there is this new regime, they're on the path to raising rates, quantitative tightening, et cetera, et cetera. You can find any number of different descriptions to describe what is a different Federal Reserve today than existed 6 months ago in terms of what it is doing within the market and what it plans to take out, and then the ultimate effect it's going to have on stocks, on valuations, on earnings down the road, et cetera. Weiss? What do you think?
You did the absolute right thing, Scott. That's all I'm going to tell you. By giving me a minute to think about things.
Been doing this a while.
Here's what I'd say.
I've been doing this a while with you guys.
Yeah, we've been doing it a while together since day one. Look, here's what I'd say. It's like a stage 4 pancreatic cancer patient walking into an oncologist, and the doctor says, "Hey, let me look at that pimple." This is not what's going on. The stocks are in a bear market. Period. The indices don't reflect it, but stocks are. Now they'll bounce here and there, but you've got a massive tightening cycle. And to think that the market's already discounted it before the first hike happens, I think is sort of ridiculous. So look, you'll get periods of volatility, as we've all said, but there are certain stocks that aren't going to work. And those are the Kathy Wood stocks. Nothing against Kathy Woods, but she's got to recommit because that's what her ETF tells her to do. I went through the docs actually this morning, and she's got very little flexibility in terms of how much cash she can have and what she can own. So she can't all of a sudden switch. So let's ignore what she said. She's got a bias, honest bias. So I stick to what I'm saying. I think
everybody's got a bias, right? Everybody's got a bias. Everybody talks their own book. The fact of the matter is, inflows have picked up into the ARK funds, and they're up nearly 8% today. And she's, become a punching bag in some respects. And we're going to see how it all plays out. But not all investors are giving up on the prospects of Cathie Wood, being able to right the ship, so to speak, and that these stocks will still have their day, albeit it may take a little while. Jim, I'm gonna give you a chance. We can't just throw these darts at you and not give you a chance to throw a little bit back, or at the very least respond. But I mean, Ed Yardeni thinks not only are you going to have more volatility, he's moved his S&P target now that he had in place for 2022. Now he's moved it further into 2023. 5,200 was year-end 22. He says, no, it's not going to work out that way, in large part because of what the Fed is doing. So make your response here, and then let's move.
Yeah, I'm surprised but pleased by the degree of vehemence in the arguments back to me. That usually means that I'm right, frankly. But look, I can only say right now the backdrop is an aggressive Fed. We know that, all right? And this is the point that I was trying to make last week with when people go to 7 rate hikes this year, it's like 6-minute abs. It's like, come on, fellows, all right, we get the joke. But in order for the market to go down, now the Fed isn't enough. The market knows that. It's the backdrop. It's like a chemical solution that is waiting for a catalyst. The bad news is, Scott, and I would like to make this point, there are plenty of catalysts out there. It's not just Russia, Ukraine. It's upcoming midterm elections. It's a continuing resolution for this government's budget that runs out in 3 weeks. There's any of a number of catalysts out there. My point is now the Fed has the backdrop for higher volatility in the market, but that's not enough on its own for it to go down. You need something else to precipitate out of solution the conditions that we're in.
Okay. I mean, look, you're going to stick to your guns. That's fine. I mean, I guess that's what it's all about. Let's bring in senior markets commentator Mike Santoli, who I'm sure has. Yes, go ahead, Jim.
That was Steve.
No, that was Joe.
No, it was actually Joe.
Right.
It was Joe.
All right, I'm going to not let anybody. I'm going to Santoli. How about that? Because we had wrapped, right? You guys know better than that. Okay. Mike Santoli is with us now. I'm assuming he's listened to the conversation.
Yep.
Mike, it's nice to see you. And really the conversation, part of it at least, is to whether, what grade you would give the correction that we just had if it was, quote unquote, successful enough in weeding out some of the excess that existed within the market. But you can opine on what Farmer Jim had to say as well about, I mean, it's almost discounting completely this new Fed regime.
Well, discounting it or suggesting that the market has largely absorbed it. I think that's one way to maybe characterize what's going on. I would grade the correction as saying, it's absolutely passing. It's achieving much of what a correction is supposed to do. It's not the same as saying it's definitively over and last Monday was the low at 42.22 in the S&P. Maybe it was. There's actually a lot of things that say at least it should be a decent spot to actually, use as a reference point for your potential downside from here tactically. But I think you have the valuation compression everyone's been talking about has gone a fair distance, right? 19 times earnings for the S&P 500. That's not cheap, but the small cap 600 is really cheap at like 13 times. Nobody wants to buy them. I understand that. But on a relative basis, the typical stock out there has taken more punishment than the indexes have. Sentiment got pretty washed out. I don't think there's a way around that. I'm not saying you had massive outflows, but you had retail investor surveys are showing multi-year lows in bullishness. At the same time, record volumes in defensive put options being acquired. So it does seem as if people have their guard up. And just on the point of whether the Fed was absorbed, the message was absorbed, all the talk from Powell in basically saying we're going to look for flexibility to hike more, not less, and the street's cycle of talking themselves into ever more hikes have all happened since the S&P hit that low. That was Monday. Right? So yes, it was a choppy week. Yes, we've had these scares along the way, and maybe we're going to get more of them. But all of that talk did not create a new low. And final point, Joe was talking 2015-16. I wrote about that over the weekend as well, because it seems like the logical kind of episode we go through in the first rate hike in the cycle when it seems like badly timed. It always seems inopportune. Even though the economy might be ready for it, that Wall Street finds a reason to feel like it could absolutely turn into an immediate mistake. And I think that that's something that you generally have to be aware of, but maybe fade. Very different economic conditions otherwise in 2015-16, but I do think that kind of crowd psychology aspect is there.
I mean, Goldman today says 5 hikes coming this year. I think it was JP Morgan on Friday moved up to 5. Now there are others. I think it's Bank of America is at 7, and that's an outlier for the moment. And surely, Mike, 7 hikes has not been absorbed by the market. I think we can both agree on that. Has 5?
7 hikes
is it
in the
4?
absence of. Look, first of all, there isn't an actual answer to how many there are going to be in an envelope somewhere, and we're just trying to guess what that answer is. The Fed doesn't have the answer. They acknowledge they don't have the answer. So it is all about a dynamic process of how's the economy going to respond? Is inflation going to crest and come back? What does that mean for their intentions to get back up to some kind of a normal rate and maybe just kind of rebuild that cushion in rates and roll the balance sheet? They're probably going to try to do as much as they can do as financial conditions allow them to do, assuming that we don't have some kind of a spill in the labor market. So I feel as if every one of these predictions is plausible. And I don't think that you can say that any particular number is priced in unless you want to look at the Fed funds futures and treat that as some kind of, kind of wisdom of the crowd's prediction, which, history says it really isn't.
It's been bleeding the market for sure. I mean, all of those have been at contract highs, before I think the investor community at large has kind of gotten there in its own right. Mike, I appreciate it, as always. That's Mike Santoli. Let's bring in our headliner now, Adam Parker. He's the founder and CEO of Trivariate Research. AP, welcome back.
Great to see you.
It was 2 weeks ago you said the following, and I noted it that day, and I mentioned it on the program, and I'm going to do it again because it was pre-Fed and pre-correction, where you said, quote, people are really out of their minds if they think the Fed is going to raise 4 or 5 times this year and 4 or 5 times next year. I don't see how that's going to happen. I'll take the under. You heard Jay Powell speak. You still want to take the under?
Great to see you. Oh, yeah, for sure I do. I think the comment Santoli made at the end there, I agree with. The Fed Fund futures, while it ultimately doesn't prove to be what happens, is really the perception the market has in interest rates and what they're going to be like in the future. And I doubt that rates will change that much. I think people got too hawkish. But, I kind of agree with Joe's comments in the end of the day, which is we need stocks to buy and stocks to sell. So we did our year-end outlook, that note you're referencing 2 weeks ago. We just came out with like 7 buy themes, 5 short themes with the stock ideas. And that's what I've been focusing on with my investors. I don't have an agenda because we write research. We just our agenda is to help our clients make money. And I think that's the main focal point, to be honest with you. I did upgrade last Friday technology from underweight to an equal weight. I do feel like if I look at historical downturns, that we guessed maybe 80% of the way through this one. The only ones that are really worse are COVID or European financial crisis or great financial crisis. I don't think we're in that situation here. So our view was, okay, let's look at what industries work if we're 80% of the way through the downturn, through 3 months after. Let's look through what signals work, and that leads us to the portfolio recommendation. So I think it's a pretty good time to stop, getting so negative on particularly the growth universe and start to add some there over time.
I'll get to that in a second, but isn't the risk to the upside on rates? I mean, I almost feel like you're in denial about where we are and what the Fed chair had to say. You got a new Fed regime. I mean, they talked about that. They sort of laid the groundwork as well for balance sheet reduction. Doesn't that factor into any of the way you're thinking about it?
It's a pretty good time to stop. No, sure it does. And, we look a lot at how markets trade statistically significant or not to changes in perceptions of rates and the reality of it, which signals work. But Scott, remember, there are hockey rinks full of people at all the firms you mentioned who memorize and follow everyone in the Fed and what they do. And they consistently get it wrong about what the Fed's going to do because the Fed doesn't know what they're going to do. My view is the Fed are the smart ones. They have access to all the information. They're not going to raise rates 8 times or 7 times in 2 years unless the economy's awesome. Okay, so let's focus on what matters. What matters is corporate earnings growth. That's what Jim said, and I agree with him. If earnings are higher in 2023 than 2022, the market's going to be higher. You can fight that all you want. I wouldn't. I think what happened here is kind of what's called a garden variety growth scare, fueled by excessive hawkishness. And I think ultimately you'll get higher corporate earnings. Now, maybe if we're backing up and being clinical, we'd say, look, the probability 23 earnings are below 22 earnings is probably a little bit higher now than it was. So, that's because the Fed may be a little more aggressive, and maybe at the time things are slowing and they get it wrong. Maybe that's possible. But I still think your base case is higher corporate earnings in 23 than 22. And that leaves you with lots of things that you can buy to outperform and make money.
I know, but you know, I don't know. I feel like we have part of this conversation every day. I mean, you used to put your CCMs on too and skate around that rink with everybody else, and now that you're no longer there,
I always have a longer perspective. No, I have a longer perspective than you, Scott. Look, like last year we came on, we were bullish on equities. We said energy was our number one sector. The market was up 27, energy was up 55, and people gave me a hard time every time. So you got to look. It's your horizon window. Look, the market's down more than I thought it was going to be in January. You have a lot of reasons for that. Big change in perception about rates fueling into a growth scare, sure. But I think if I look out with any perspective, I focus on what would make me want to call the top. It's around management arrogance gone awry. It's capital spending, hiring, inventory impeding margin progress, fancy new corporate headquarters, all that stuff. I don't see a lot of corporate excess. So you're going to try to time these exogenous events. And I look back at my history in the last 20 years. When did plotting any of those things on your computer? I think Jim said the word Crimea. I typed in Cyprus and all these things, banks in Italy, every single time the market went higher because corporate earnings were higher. I don't love the 2015-16 analog. I think there's elements to it are the same, but we didn't have a FANG M then. We didn't have, it was just becoming an acronym then. So I think there's always an imperfect historical analog, and I get things are always a little bit different. But when I focus on corporate earnings, I think they're likely to grow. I think the opportunity of the growth stuff that's sold off the most to me is biotech. Did you know that only 15% of biotech companies ever generate positive free cash flow anyway? So this whole terminal value argument, because the rates are rising, kind of doesn't make sense to me anyway. Maybe their cost of capital gets a little higher as they access markets. But meantime, the whole sales pipeline's the same. So I'd probably be picking around there looking for innovation that's on sale today. And the rest of it, I agree with some of the group, Weiss, et cetera, on free cash flow. That's where you got to focus.
Let me ask you this. Let me just get a little bit more on this increased exposure to growth.
Sure.
How selective within that complex do you want to be? Are you suggesting now's the time to buy some of the ARC-type higher valuation stocks because they've been too overdone to the downside?
Look, we all know that if we get directionally dovish sentiment, they're going to rip. I'm really not recommending that. I'd say of that, maybe the biotech part I like. We still think you short profitless software, stuff with decelerating revenue growth and negative free cash flow. We pitched Bill.com as a short idea in our year ahead note a couple weeks ago. You probably saw. To me, it was just a microcosm of decelerating revenue, 27 times forward sales, and negative free cash flow. I'd rather long the biotech innovation against that as an example. Most of the other recommendations we have that are growthier are either positive free cash flow, or maybe CRM or Microsoft, or stuff where tech where maybe expectations are very low. Like I like Dell a lot here. Where I feel like negative revenue expectations embedded in the consensus, but you got Dell on your side as a big shareholder and people are probably too negative. I love UNH and healthcare services that have pricing power. So there's things you can own. Obviously we still love energy and materials. Those are still our top two sector recommendations in the market, and we continue to think they're massively dislocated with tremendous upside.
You've been dead on with that call, and you deserve props for that. I appreciate the conversation as always, AP. We'll talk to you again soon.
Yeah, always good to see you guys. All right, hope to see you soon. Take care.
All right, you be well. That's Adam Parker, Trivariate Research. All right, coming up, we're going to take a quick break. When we come back, it's the worst stock in the NASDAQ 100 this month. Steve Weiss owns it, and he's going to be on the hot seat next. Plus, we have committee moves to discuss, and we'll do it when we come back. And you deserve props for that. I appreciate the conversation as always, AP. We'll talk to you again soon.
Yeah, always good to see you guys. All right, hope to see you soon. Take care.
All right, you be well. That's Adam Parker, Trivariate Research. All right, coming up, we're going to take a quick break. When we come back, it's the worst stock in the NASDAQ 100 this month. Steve Weiss owns it, and he's going to be on the hot seat next. Plus, we have committee moves to discuss, and we'll do it when we come back.
Welcome back. I'm Rahel Solomon, and here is our CNBC News update at this hour. At least 5 historically black colleges and universities have reportedly received bomb threats this morning. Bethune-Cookman University in Daytona Beach, Florida, locked down this morning after receiving a threat. Earlier this month, at least 8 historically black colleges reported threats in a single day. British Prime Minister Boris Johnson apologizing for attending parties during COVID lockdowns. He says that his government will make change and can still be trusted.
Firstly, I want to say sorry. And I'm sorry for the things we simply didn't get right, and also sorry for the way that this matter has been handled. It isn't enough to say sorry. This is a moment when we must look at ourselves in the mirror and we must learn.
Meantime, opposition Labour Party leader Keir Starmer slamming Johnson for ignoring COVID rules and not showing more regret before today.
By routinely breaking the rules he set, the Prime Minister took us all for fools. He held people sacrificing contempt. He showed himself unfit for office.
You are now up to date. Scott, I'll send it back to you.
All right, some spicy stuff. All right, Rahel, thank you, Rahel Solomon. All right, let's talk about Moderna. Down 35% since the start of the year. It's on pace for its worst month ever. It is the worst performing stock this month out of the NASDAQ 100. Steve Weiss, I need to know what you are doing with this stock today and how you are positioned, and I know that our viewers want to know as well.
Sure. So I actually brought a little more this morning on the news, but I've been very clear. Last week when Bryn Talkington and I were talking about it, I tweeted out that that was the first day that I wasn't hedged in many, many months. And I've said repeatedly on air, and it's in my disclosures, that I've been selling calls aggressively and buying puts. And so that's what you do with biotech stocks that are event-driven. During the lulls, it's open season for the shorts, and it gets heavily shorted by hedge funds who, push whatever story they want to push. But right now, and since Bryn and I discussed it last week, I have no protection on it, so I'm straight long. The fundamentals have not changed. If anything, the fundamentals have gotten a lot better. It's not just Moderna. Biotech was the worst performing index last year, I believe. BioNTech was down a similar amount. Novavax was down more. Pick one. Some have completely blown up. That's what happens in biotech, which is why you have to hedge your positions, and that's what I did. But the pipeline's grown over the last year from 23 to over 40. They have $15 billion in cash. They've already booked, although it doesn't show up until they deliver, $18.5 billion in vaccines for 2022, with options that governments and institutions have taken on another $3.5 billion. So this is so much more than a COVID company, as I continue to say, but like any other stock, they're event-driven. Some decline in between earnings, some decline between results and trials. So my fundamental view hasn't changed. I recommend that's what everybody does, as I've said repeatedly. So that's my thought in Moderna.
Okay. Good stuff. I really appreciate you going into so much detail for us and our viewers, Steve Weiss. Okay, Liz Young, that plays into a biotech conversation of whether we should be bullish or not the space, as Adam Parker told us before the break, that we should be, albeit there may be some risk in certain stocks. What do you think?
Well, let's take healthcare as a sector as a whole, trading about middle of the pack performance-wise year to date. I think healthcare is a great place to hide out during rate volatility. And then you break it down even further, look at things like biotech and pharma, and know that they're a little bit more growthy in the healthcare sector, so they're going to see more volatility as we have rate news. But then you've got healthcare equipment and services that kind of balances that out. I think healthcare is a great place to be here, and I think it's a great place to be for the long term. I used it as my final trade last time I was on.
Okay. Joe, a few things to discuss with you. You were stopped out of Interactive Brokers at $65. Lam Research at $5.54. This is late last week. And Lam, along with Teradyne, were absolute disasters last week. The money that came from those investments went in to Goldman Sachs, which is a new position. Take me through that.
Okay. So I had owned Lam Research since March of 2021. As you said, terrible report. I owned Interactive Brokers for a couple of months. It has done nothing but deteriorate, and I think the retail participation after the month of January is only going to decelerate further. So how to get out of both of them? What I wanted to do was go into a financial institution, and I went back and looked at Goldman Sachs. I know Jimmy's going to be happy about this. I sold Goldman Sachs at around $355 post-earnings, picked it up last week, a little bit lower. It's a company that I know. It's a company that when I survey all the capital market financial institutions that I have available to me, it still scores the highest. So that's why I went back into it, had cash available to do it. And on the other side of that, Scott, Lam Research, I wanted to be in semis. And I know Lisa Su, her guidance is generally something is very strong. I sold Lam Research early January at 128. AMD, I'm sorry, apologize. Sold AMD at 128 early in January, able to pick it up below 105. I want exposure in the semi space still, even though I'm out of Lam Research. No problem buying it there. I think these are the type of opportunities you want to look at in the market.
Okay. Still ahead, we'll tell you the ETFs you need to watch today. Plus, Joe was just talking about some semis. They're higher today. They're still on track for their worst month since 2019. We'll give you the trades and a new stock buy that is next on the Half.
In the semi space still, even though I'm out of Lam Research, no problem buying it there. I think these are the type of opportunities you want to look at in the market.
Okay. Still ahead, we'll tell you the ETFs you need to watch today. Plus, Joe was just talking about some semis. They're higher today. They're still on track for their worst month since 2019. We'll give you the trades and a new stock buy that is next on the Half.
And welcome to the ETF Edge portion of Halftime Report. I'm Bob Pisani. After being ignored by investors for many years, dividends are hot again. Why? Let's talk with Simeon Hyman. He's the global investment strategist at ProShares, who runs the ProShares S&P 500 Dividend Aristocrats ETF. That holds the S&P 500 stocks that have increased dividend payments annually for at least 25 years. Simeon and I reported Friday that we're seeing record payouts for dividends this quarter from the S&P 500. big heights from companies like Halliburton, Lennar, Wells Fargo. Why are dividends a hot topic right now in the investment community?
So first, I'll take Oz with your first comment, because we've seen consistent flows into Noble, which is about $10 billion, the S&P 500 Dividend Aristocrat Fund, consistently over the years. And that, I think, is the key here. Not just to focus on the folks who maybe have a cyclical opportunity to do an unusually large dividend increase, but the consistent ability to do so. So these aristocrats, as an example, at the depths of the pandemic, grew their dividends 14% in 2020, 10% last year. That consistency and quality is key. But to your point, timely, absolutely. It's a very important hedge against inflation. Growing those dividends consistently and in excess of even elevated levels of inflation are really important. And finally, dividends are such a powerful signal. Nobody wants to cut a dividend. If you increase your dividend, that's management telling you they have some confidence going forward.
Yeah, and with lower expected returns, of course, a 2% dividend yield can make a big difference in your total return. Let me just change the subject a little bit. We last had you on in October when you launched the very first Bitcoin futures ETF, BITO. That was quite an event. Bitcoin prices went up going into that launch, but essentially they've been moving down since then. How is the Bitcoin futures ETF trading? How well is it tracking Bitcoin?
You know, I think that's one of the most powerful stories here. We've seen continuous inflows even during this downturn in Bitcoin prices. So that in and of itself is an important comment on the staying power of Bitcoin and cryptocurrency. So that's really important. We're seeing very good tracking to underlying spot Bitcoin. The fund is doing exactly what it's supposed to do, and it trades very, very well. In fact, Bitcoin volumes, the futures market that Bitcoin follows, is actually trading substantially more volume than the largest U.S. Bitcoin exchange. So there's a lot of volume, there's a lot of liquidity, there's a lot of trading in the ETF, and very good tracking to spot.
All right, now we're going to have much more on why dividends matter in 2022 coming up on ETF Edge. Simeon will be joined by Todd Rosenbluth, head of ETF and mutual fund research at CFRA, who will also help us sort through which dividend ETFs you should own in 2022. Plus Dan Egan, he's the managing director of behavioral finance and investment at Betterment. He'll be talking about the recent collapse of the meme stocks and what he is advising Betterment investors to do. ETF Edge at CNBC.com, 1 p.m. Eastern Time. Halftime back right after this. Simeon will be joined by Todd Rosenbluth, head of ETF and mutual fund research at CFRA, who will also help us sort through which dividend ETFs you should own in 2022. Plus Dan Egan, he's the managing director of behavioral finance and investment at Betterment. He'll be talking about the recent collapse of the meme stocks and what he is advising Betterment investors to do. ETF Edge at CNBC.com, 1 p.m. Eastern Time. Halftime back right after this.
Hey, Joe Terranova sent us a note saying that after the bell today, he is going to be buying a stock, and he wanted to tell you all about it, and we're looking at it on the screen. Joe, tell us about Nike. What piqued your interest here?
Well, Nike is a name that for the last couple of years I've known well. It's a name that I've known. And listen, the value of this stock, of this show, really, Scott, is the authenticity that we all bring to it. Last summer, I was obliterated. I sold Nike at 125. Literally the day before it had that dramatic spike up higher. So I sat out on the sidelines, but now the market is giving me the opportunity to buy quality. It's a company that trades at a reasonable valuation. I believe we are going to ultimately be moving to an endemic environment. That bodes well for reopening Vietnam, which is manufacturing a lot of Nike products. And let's remember, in the last quarter, China was underperforming, clearly. And you're going to see a revival of the growth for China and the revenue contribution as we move forward in coming quarters, certainly with easier policy on the monetary side from the Chinese. So overall, I'm going back into the name. Okay, I took my criticism for what I did last year. I accept it. But this is the perfect spot to get back in this stock where it is. I'm going to buy it on the close.
They'll buy it on the close. It's 18% off of its high. It's down 12% this year. And, Joe, I'm looking at a 1 year of it on CNBC.com, and it's okay. Over a year, it's up like $10. I mean, it's not that far from sort of a flat-looking move from a year ago till now.
Well, it's fallen off, as you just defined. It's fallen off significantly. So it allows me to take advantage of a name that I know. And I suggest to all the viewers right now, with markets trading with this volatility, focus on the stocks that you know well. And those are the stocks that you want to be positioning in, or building positions further, or establishing positions. Go with what you know.
Looking at like 177-ish, look like the high later in the year, around November or so, to where, as we said, it's come down from here. So we'll keep our eyes on that. Again, Joe Terranova telling us right now that he is going to buy Nike after the close today. There's a look at the stock. We're back with more trades right after this.
Go with what you know.
Looking at like 177-ish, look like the high later in the year, around November or so, to where, as we said, it's come down from here. So we'll keep our eyes on that. Again, Joe Terranova telling us right now that he is going to buy Nike after the close today. There's a look at the stock. We're back with more trades right after this.